Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update, almost mid, but still early session for Friday, April 4th, 2025. Just felt like getting one more video out and just going through the charts. I've been firing off as many trade ideas and trade updates as I can, but there's a lot. There's a lot of stuff out there. I always say any trades that I've thrown out there, or any of the trade ideas shared here, you got to, just mark up the charts yourself, set your buy and sell limit orders or stop orders, and, have a trading plan and stick with it. If you have any questions, let me know in the comments section. Let me cover this chart. I marked up the S&P 500 today. I will say this chart does have, and I've used half a dozen different charting platforms. A lot of them have real time on the S&P. This one's delayed, but it's kind of my go-to charting platform. It's just clean and easy, and it's the one I usually share charts. I just want to say there is a 15-minute delay. But we're off the lows, so that bottom candlestick should hold. We hit the lows today so far, which, knock on wood, I believe that is the low. I'm going to kind of call it as such, not at the risk of eating a lot of crow, but I think it was 10:52 a.m. right here. I believe that's, Qs are my preferred trading proxy. I believe that'll mark the low. Now we have to take out, well, I'll get to the levels in a second. We need to pop some overhead levels to trigger a short covering rally and regain, like I said earlier, like Apple and stuff like that, that it's just dipped below what I call momentum. Most likely, only time will tell if it is a momentum fueled overshoot. So if we can get get back above those support levels, that's where the short covering rally will come in. God forbid Trump tweets something out. Strap on, hold on to your seat, because this market could explode higher. Again, the risks are bilateral. It could break. I've talked about that ad nauseum lately. So if this is your first video you're watching, check last view and my comments. When the market falls hard and fast, things can break, such as a hedge fund, a bank, non-bank financial, anything. I don't, it's not my preferred scenario. I think we go up from here, but if we do break, then we go lower. But let me go back to this chart. It's interesting. So it's a very clean chart. Clean meaning I don't have a lot of lines here, but you can see a well-defined support level that we hit today at the lows on the S&P 500, about 51.24. It was that major reaction low. That's that famous August 5th low. I love it because we were short that whole move down, biggest drop up into that point, and we covered with impunity in pre-market, actually. So we were actually a little below where you see the S&P and the QQQ's bottom on the daily chart, because I got to post out to you, because we hit, for many reasons, you can visit that post, we hit the NQ futures targets being hit, and everything falling to its 200-day moving averages, key uptrend lines like this one here. Either way, what I'm going with, it's a very significant. It's not just a reaction low. It's after a big drop and a big reversal off it. That makes that distinct reaction low very technically significant. Now, support is support until it's broken. If they break it, then boom, that's it. Right now we have a reaction off it. It's an intraday reaction. This is the first day we've hit it. We could close a day below it. But as of now, I will take it for what it is. It's support. So for a reversal off, it's a reversal. I still think we're gonna odds favor a bounce today, and that's it. So you could also see here we had a pullback after that break to new highs there, and then it broke, back tested, and finally regained it there. So there's some additional reactions there. What's also interesting, you can see some on to the left of the chart. Unfortunately, I can't make these bigger, but what you see is it says 38.2. These are what we call Fibonacci retracement levels. Let me sure. I just see I was slightly above there. It's right on there. So what I did, I measured. If I scroll back here, this was that was the lows, the end of the bear market in 2022, if you want to call it that, or correction. I'm talking from the highs from the beginning of 2020 into the October lows. So for those of you not familiar, I encourage you to look these up. Learn how to use Fibonacci retracement tools. Very valuable part of trading. Essentially what you get is you get these Fibonacci, key Fibonacci levels, and a typical pullback or retracement within a trend, whether you're using a 5-minute chart or a weekly chart. This is a daily chart. Most pullbacks are contained anywhere from the 38 to the 61.8 retracement if they're just corrective waves. Now, I do think we're going a lot lower. I think the 38 and the 50 will get taken out. But some traders exclusively use Fibonacci retracements and projections and other fib tools in their trading. To me, it's just part of, but I've been using them for many years, and it never fails to amaze me how effective they are, how often pullbacks and corrections or even bear markets are contained within within Fibonacci, certain retracement levels. So there's the 38.2. Again, it's measured from the lows right here. That's this yellow line. I just angled it. Just what it does, it starts there and ends there. And you can't see it because it overlaps with that price support I already had on there to 51.24. And it's a perfect 38.2% retracement, meaning so from that move, this entire bull trend, the leg off the October of 2022 lows to that high, we've now retraced a key Fibonacci level of 38.2% of that move, right? And there's the 50% fib right here, which, and again, guys, it's just, it never ever fails to amaze me when I put these fibs up. I always mark my charts up first with horizontal price support and resistance levels. Then I'll typically add the fibs on top of that, or I'll have a different board with fibs only. And you can see that was the all-time high, or the previous high, all-time high then, the start of the bear market, end of that bull run, and then the drop. And so that 50, that's a key major reaction. Traders always look at pivot highs, pivot lows, especially such a significant one as that. And that's exactly lines up with the 50% fib. And so that would be a logical next target. Whether we bounce or not, it's price support. And there's also a little jog there. We hit it, had a pullback because that was a previous high, and then a breakout, and then off to the races once we took out and made a new high in the S&P right here. Okay, and then there's the 61.8 is down here, just so you can see that. Now, gets a little more interesting. This I've had up here, I put this back here in January of 2022. So obviously I did that. Why did I do that in January 2022? Because I thought we topped. You can see I have not modified that line. We talked about it. You know, we were short then off the highs in 2022. And so that one was measures the move from the COVID lows. This entire bull run or bull market after COVID hit, bottomed out in March of 2022, or the market peaked then. Yeah, it was still March of 2020, I'm sorry, 2020. And if you measure all the way up to the high, that's this blue line here. Here, why don't I just take this one? I'll just leave it there. Or I'll move it. I'll move it out of the way so you can see. Let me get it way up out of the way. So this was the entire bull run from bottom to top. There's the Fibonacci measuring it. And that, and I'm going to zoom in right here. This is a 50% fib. Now, you can see here's the 38.2 fib. Again, 38.2% retracement of that first bear market. We hit it to the button there, and it doesn't look like much, but I'm going to crosshair it, pull it up. You can see the pop-up box to the left. That was an 11% rally. So we certainly had a tradable bounce or a reaction off there. Then we went down, and if I zoom in really close, again, I haven't modified it, this bear market, that last one ended right at the 50% Fibonacci retracement and then reverse. So what I'm showing you is, again, it's not a be-all end-all tool. It's one of many tools you incorporate. I'm just showing you today we hit the 38.2 for the first time on the S&P 500. Okay, for shits and giggles, just throw it up on the NDX. I usually track QQQ. Here's a NDX, NASDAQ 100. Just click on your fib tool. Some they start at the top and go to the bottom. On this one, you start at the bottom and go to the top. So I'm taking the lows again from October 2022. This yellow, here, I'll make it purple. So I'll make it white. You can see white better. There it is. And right to the highs, let me just zero it in there. It's this horizontal line you want to level with the top. And look where we're at now. The NASDAQ 100 hit the 38.2% retracement again today. So again, these are levels that I expect to go in the coming weeks to months. It's a matter of, are they going to go today, and are we going to go down to the next one? There's the 50% Fibonacci retracement comes in with this, and there's some price support in there as well. Or do we bounce first? So like I said, if we can recover back above Apple, and I'm seeing I'll get to those in a second. I'm seeing the Mag 8 hanging in there. They're all down because they were down from the futures this morning when China, started at 6 a.m. as I covered earlier when China initiated the reciprocal tariffs. But they've been since the markets opened up. They're actually 1, 2, 3. Almost all of them are off their pre-market lows. Here, I'll show you. Let me pause this. Oh no, I can just drag over here. So this is I've got a lot of charts going here. You can see in the here's Apple. This marks. Let me grab. Where's my drawing tool now? That I moved everything to another monitor. Here it is. Okay, we got it here. There's the pre-market low. There's a plunge at 6 a.m. when the reciprocal tariffs were announced from China. There's Apple's low, and so far it's off the morning lows. There's Amazon, well off. I told you Amazon I like. Alphabet, well off this morning's lows. Microsoft, also like that one. Told you that one's at support. Meta, they're all pretty much, except Tesla. Oh, sorry, I take that back. Meta had the pre-market lows there. See the shaded area. If you sometimes maybe need to do a better job of convey what I'm talking about. See these shaded boxes. This is post and pre-market. These are the outside regular trading session trades. This is the regular session. I'm on short-term charts. These are like, I think, 5-minute, 2-minute candles, streaming charts. And so there's the regular session. So that's that shaded area. That's pre-market lows, pre-market lows. Here's the opening at 9:30 a.m. right, I think about there, that darker black box. And then so Meta, but Meta is now above the pre-market lows. It had a post-opening dip. So did Tesla. Oh, I realized that I'm only captured a small part of my screen. There's Tesla. And you can see some of the other stuff there. So I just wanted to say that they're holding up relatively well. I see some buying coming into those names right now. And again, the magic number, when you see things like Apple, who, this is that level I told you yesterday right here. Nice, really nice support. I mean, why is it really nice? That's a major reaction high. Again, it was a high to get short after you broke the trend line. Divergent low took us back up, gave us a divergent high, bearish rising wedge, sell signal down low. So Apple was ping-ponging here in this beautiful, super well-defined trading range, had a breakout. And because that was such a well-defined, perfect trading range, just like the topping pattern we just put in the markets that was highlighting for months, boom, we broke out, we exploded higher. Apple did. And then it came back. This, guys, is textbook. If you were, if I was going to write a textbook, I would use this chart as an example of technical analysis. How this is well-defined resistance. You got the divergent highs and the bullish, divergent lows. How you swing trade within that range, and then how, like I said with the stock market recently, that no trading range lasts forever. That sooner than later we're going to break out, and that I can even tell you which way you expect the breakout to go. On the recent stock market, that is the trading range there that we had on QQQ up here at the highs. It's Apple's a little different, but there's a case, and I always say respect whichever way they break out. Apple had an upside breakout, and you didn't have to squint to see it. It was a massive green candle followed by a second huge green candle, and then this is textbook as well. Resistance once broken becomes support. So if you missed that run because it was just too fast, that was a rip your face off rally in Apple. And if you didn't have time to get in, well, guess what? You were offered a gift, a present on a back test right there. So this is how now here we are back to that level again. Now, like all levels, support is support until less broken. It has been broken. So at this very moment, there is no buy signal. I told you yesterday I'd like to see if Apple could come down another 2%. That'd be even better. We'd hit that support level. We hit it, but we also went below it. Now, the million-dollar question is, will this prove to be what I call a momentum-fueled overshoot? Because it was a vertical plunge to get there. A lot of velocity and momentum, and so you had that inertia that will often carry you through. However, right now, we haven't recovered, just because I suspect that we might and probably will recover that level, and then that's the buy signal. So, and it's not much. You just wait patiently. Here we are right now at 194.93. We got to get back above, at least, we'll just be safe about 198, 199, and then that would be bullish for Apple. Now, Apple is still the largest of all the stocks out there. It's 3.4 trillion. It's still in that 3+ trillion club. It has the highest weighting in the S&P and Nasdaq 100 because of it. So it will influence and have a big impact on the indexes due to the market cap weighting that they're structured with, meaning the bigger the market cap, the higher the percentage attributes to the gains and loss of that index. But you want to see collectively, they all need to rally. Microsoft's still at that support I wanted to see yesterday, if you remember, was right here, that yellow line. So we did get that additional 2% drop, and that's it. So right now, it would be a big thing. It's not a be-all, end-all, but to see Apple get back above that support level, just because these guys are holding up above the pre-market drops, doesn't mean they're out of the woods. I mean, this is fugly price action. Don't, as far as, the buyers just, haven't been able to step in yet. So you have the potential divergences. You have a nice potential bullish setup. It's as if the markets won't do anything. The buyers aren't going to commit until I think they see something come out of Washington, some kind of positive headline come through. And if we don't get that catalyst, or it's even worse, remember, China retaliated. Who's next? China's the biggest trading partner, but, there's a lot of, we still have the spat with Canada and Mexico and, all our allies in Europe. So, these blanket, blanket tariffs of just about every trading partner we have. So, it could go the other way, guys. I'm showing you the levels, which way I think it's likely to go, but then when to act on it and when not to act on it. So, like I said, I think it's objective being long here. I would just add to, if I can see Apple and all these other companies pop back above anything that's broken support today, if it can get back above support, that would likely cause a short covering rally. However, there are other things that have broken support. Let's just rifle through everything real quick. So, all right, I already covered Apple and Microsoft quite a bit. There's NVIDIA cracking actually right on it. I had that support level here. Remember, NVIDIA is still a long-term swing/trend trade. I gave you weekly charts way back here. This is all part of the same top I called for it here. We had a bearish engulfing right there. And remember, it's an extension of the trades, this one and along with the market calling tops last year. We made marginal new but still divergent highs that didn't even remotely come close to exceeding any reasonable stop. What does that mean? Glad you asked. I always say in trading, I'm either going to be right on a trade, meaning I hit my profit target, or I can be early. I can be early and still be right or wrong. What's the difference between early and wrong? Early on a trade means I go, let's say in a short trade, I go short, with the intention that the trade, that's still my final target. These are just potential targets down here, but this is still my final. Has been since last year. I haven't changed, waffled, modified these targets. So if I think we're going from here to here, ultimately, but zigzagging, remember I had T1 here, and I expected a reaction. That reaction went slightly higher. But when you do any reasonable RR minimum should be 2-to-1. It depends on the trade. Sometimes I'll use a 2-to-1, 3-to-1. Sometimes I use a 5-to-1 RR. That's the risk reward ratio, meaning the amount, units of loss that you're willing on your stop to risk relative to your downside target. So, this short trade was initially entered back here. With additional add-ons there, 70% drop. So using a 2-to-1 RR, you'd give a 35% stop loss. Using a 3-to-1 RR, you're going to give yourself about a 20-something odd percent stop loss. So as you can see, well within that range. So I just wanted to say, you can't even call it early because we hit right away. We hit my first target and we bounced. And we didn't just bounce, but I made a post. We hit that target on, you got it, you keep hearing about it, morning of August 5th, I'm sorry, that was intra-week. This is a weekly candle because I made the point to post pre-market covering all shorts, and using my air quotes, and reversing to a full long position, meaning hard long. That was what I call a hard reversal, coming in pretty heavy short. And on one instance, at one moment when all these targets were hit, went to, covered all those shorts, went for the long swing trade. So the bounce It took a little longer to run its course than I figured at first. But again, it only made a slightly new marginal and still divergent high. That was a divergent high. That was the whole case for laying out these long-term targets. And this is how my price targets work. You typically hit the first one, you have a reaction, then you go down. As you can see, we're starting to crack. But when you look closely, I didn't want to change the targets. That's where I had it before. But really the support level now, because you established that slight undercut right there, that is then the previous major reaction low, that August 5th low. And that's where we're at right now in the video. I just wanted to say that. So even though we're below the former T1, I just didn't want to change because I've had these levels here, going back since last year. So I didn't want to change them. That's the original targets there. And so that's it. So basically, again, when I go to the daily chart, and you can see there's the August 5th low is right here. Again, 200 days, that price target on the weekly, and that's about what we hit today so far. So you have NVIDIA coming down to really good support, a stock that I think has so much more to fall. Last time that we gave you a swing short entry was right there on the deep seek, right here on the deep seek gap backfill, highlighted that day there as a objective short or add-on to anyone in that long-term trade, and you made 35% in a matter of just a couple months on that. But now, again, everything zigzags on its way down, whether it's going up or down. So looking for, and where to? I'd say I can pull this line. I'm going to pull it up for you a little higher right now, right about there. It's a logical bounce target, about 103.82 minimum target. There's a gap if you want to just target the gap. And you can, if you take it long or cover your short, if we break that support, I'll give you these frequent updates. There's a lot. It's not only about NVIDIA. Just remember, birds of a feather flock together. So the Mag 8, for more or less, are going to move together in concert because of the high correlation and on the weightings in the index. There's Amazon. That yellow line has been yellow for a long time because it's a big level. It was and still is, in my opinion. Big support level, big old gap there, reaction, another massive gap right there. This one's at support with positive divergence. Again, that positive divergence indicates to me that if we do reverse and reverse soon, as in today, we can't go much lower. The divergences will get taken out if we go much lower. We could see a multi-week double-digit rally that could, again, easily, potentially take us back to the 200s. And if it is news-induced, if there is some kind of kumbaya moment with Russia and U.S. and with the tariffs and the trade wars, it could happen so fast that if you take a couple days off, you might miss the whole thing, or not. That's trading. I'm not trying to mix words here or give you wishy-washy analysis. This is what I think is a more likely scenario than crashing here. But we got to step in soon, or things start to break. If we go down, the rubber band's getting really stretched, and that's where, like I said, hedge funds and institutions start blowing up because they were just too many bulls had their hands in the cookie jar, and just stupid AI to the moon kind of hype and all that, and everyone buying SMCI, which covered that for you today. That's just been a monster trade. And not only that, I mean, we first shorted this stock right here. Oh no, on that day, on that high. Then on that breakdown there, we milked it down to, I can't remember now, the target was so long, those targets were somewhere down here. We milked that short run. We've had plenty of long reversals. This stock has just been a field day to trade. As I showed you today, these were the last two highlighted short entries right there and right there with these 4 targets. I still maintain T4, may even extend those targets, but again, we're at T2. We undercut it a little bit, but it's all about that kind of, that's why I'm doing this video, to see if we can reverse. So I think these are momentum fueled overshoots. Usually I'd say a break at T2 opens the door to the move down to the next target, which is T3. And we need to go like that. Maybe, but like I said, if the market reverses and the machines start buying, the buy programs start firing off, everything's going to get lifted. And the beat down crap, including SMCI, is going to get lifted with it too. Yeah, I don't know what else to add, guys. Really, it's like the market's sitting right now. It's not, it's as if it's waiting for the next headline and to go in either direction. I want to say with China finally firing, and again, I said it this morning, that was anticipated. We knew that was, hold on, let me back up. First of all, for the life of me, and I mean this honestly, not facetiously, I would love to meet the guys and gals that were buying here. I would love to meet the guys and gals that bought this market, ran it up when Trump was elected. Because look how the news goes. They attribute the rally after November 4th to Trump being elected. Okay, or November 6th, whatever the election day was. They'd call that the Trump pump, the Trump rally. Trump's pro-business. Trump's going to deregulate, remove. Trump ran on tariffs. He was unwavering that he was going to slap tariffs. So all of a sudden, it's news as of the other day. Guys, there's never been more well-known in news that should have been priced in. So again, I don't get now. Again, you can argue that they came in a little harder. It's, because he does say a lot. He talks big, and I guess what I read and heard is the media and the quote-unquote brilliant analysts and pundits out there had downplayed or underestimated what he would actually do. Again, we also know that Trump's negotiating strategy 101 is go in big, ask for the moon and stars, and you're going to get the clouds. You're going to get, settle at a much lower level. If you want to buy a car at 50,000, don't offer them 49. I mean, don't offer, and they're asking 60, don't offer 50, offer 30. And, that's the whole negotiating, coming way low and gives you more room. So that's what he does. So we'll see. All right, guys. Anyways, we could talk the tariff stuff and everything else. Now, I'm going to say one thing. Okay, so that's just kind of setting up the stage. It will probably bounce soon and could be hard. But nothing's changed on my longer term outlook. Not even close. And fact, yes, I'm sorry. That's an incorrect statement. Something has changed on my longer term outlook. The probability of those longer term targets has only increased substantially over the last few months because I was correct. In other words, calling for this move down. The mere fact that we've now dropped this much wipes out this wealth effect. Everybody that, whether you were long here, or you're buying here, that's a lot of wealth wiped out. I know. I mean, I've got friends texting me, some people in tears. I was in the hospital after surgery. I had to get around and walk the overnighted, and then I had to stay in the what do they call it, the recovery room or whatever. And I was doing laps because they said you got to get up and walk. It helps with the surgery, the stitches and all that, and just with that gas they pump you full of the CO2 to move things around inside. And I recall this one nurse at the nursing station, just every time I was walking, just buried on her. She had the monitor open, had they sit there when they're not doing anything at the nurse's station. Had a Fidelity account up, and you could just see the look in her face. And that was before this. That was last week when we were flagging here. So I know, and a lot of people are panicking, feeling a lot of pain right now if they're on the wrong side of this trade, and then hopefully more listen to my voice or very happy that they've not only not lost money, but actually made a lot of money off this drop. Again, that was the golden moment was the other night when we hit the this one, the lights out support right here. That was the day he announced the tariffs. And earlier in that day, I covered this level right here and the comparable levels on QQQ as my lights out level. And that was certainly what happened. The lights went out in the market, and and I said I'll take it on faith. And I even went additionally further so far to give you a trading strategy on there, is to not just I said, look, you can take it with a grain of salt because sometimes these news sudden events fail. But if you take it, just set a stop take it on faith. And then, boom, if you did that, you would have never been stopped out. We just kept going from there. So that's where we're at. But the name of this game is you're only as good as your last win. So we got to keep going here. And right now, it is a little fuzzy. I will say that, meaning the outlook, the near-term direction. Long-term has only gotten more firm, as I just said, only simply because this has happened. And I don't think there's a person out there that knows economics and finance and the markets that will argue that the wealth effect is extremely powerful, and probably at no other point in time other than maybe the 1929, roaring 20s leading up to the crash of 29 is the wealth effect. Everybody's gaming the stock market. COVID hit. I mean, my yard guy's probably out on his phone right now, cutting the grass, looking at his Webull account or whatever. Everybody's got their hand in the cookie jar, with, especially with crypto and all the speculative crap. It started with them meme stocks, AMC and GameStop back then, and it migrated into the AI bubble and hype. And people that 5, 10 years ago didn't really play the market, just put money in. Everyone's gotten more involved. And so when you get these quick rundowns, again, what I'm trying to get at, I'm not trying to sound callous for me, it is the wealth effect. A lot of wealth has been taken down, especially in the indexes don't even tell the full story. It's the crap that was the hottest, like our SMCI, trade. And when I quoted the 55 to 56% return right now, whatever what that was, maybe I what did I say? Whatever it is from that was the downtrend line, short highlighted there. It's down 60%. Remember, we're also short down here. Here's a stock that's down off the highs, 76% off its all-time high. And by every metric I look at on this chart, this was a nice textbook uptrend with a blow-off top. That's a signature blow-off top. Look at the volume. We call it buying climax, blow-off top. And this has every making of a downtrend so far. And ultimately, again, I said I'll have deeper targets. I'll probably add to SMCI. This is where I think it's going. So, if you think it's bad so far, if you happen to have bought that high and the stock's you're down 76%, there'll be kickback rallies. I'll tell you what, I would love to see this stock do this. Give us another run at that trend line. Just recycle back in, provide a more objective add-on or re-entry point if you covered today, which I think is prudent. Again, if the market's going to bounce, this one's going to bounce. I favor reaction here. Anywho, we'll see. We'll see where we go. I don't know if we'll get that high. I'll mark this chart up. And sometimes I get crickets on a lot of these trades. So if you're in it and you want updates, let me know. Otherwise, if no one's in this, or some of the others, I'm going to tell you what I had. I'm not always so disciplined on the stops. I give out sometimes suggested stops. This one did hit, and I updated it because I just sold it today, and I'm updating now just in case anyone else is in it. I threw this trade idea out right here, back on right around this time. It's still listed probably in the active trades. And I gave a suggested stop under 69. I think on a daily close below 69. I think they clipped it by 1 day, maybe 2 days there. Again, I just put it away. I watched the charts on that one because I'm an active trader. I don't always have the hard stops on all positions. I put it in a couple long-term accounts. Small amount either too. It wasn't much. Believe me, it wasn't a monster trade at all. But I just sold it because I had T2 up here, but I'm telling you this now. If those of you that might have used a different stop, remember all my stops and profit targets are just that. They're just suggested levels based on a lot of variables. But that's a big, massive gap. And for the life of me, I don't know why I had T2 up here before. I can see why that reaction low. But this to me, it's been, again, it's not a very super profitable trade anyway. It's 30% if you held it. Otherwise you got stopped out. I'll consider it for the record books a lost trade. There's a good example being early and wrong. Early is when I get in early on a trade and it doesn't stop me out and it takes a while, but then ultimately hits my price target. Wrong is being stopped out. That's wrong. This is considered for the record books a loser, but I'm updating that just in case anyone else took it. It's had a nice run. They say the reason is, and I picked it from the charts, but the reason that Dollar Tree is going down is Dollar Tree has a way higher exposure to Chinese-made goods than DG. Dollar General has much more domestic. A lot of the products are manufactured domestically, and there's DLTR, which actually now looks really good. Guys, I promise you, at some point, Trump and Xi Jinping, whatever his name is, China, they're going to shake hands. They have to. It'll be mutually destructive to have a trade war between China and the U.S. that goes on for an extended period of time. Mutual destruction. This is a nice looking chart. And what you have here is a trading range. I'm not buying this one now. We're smack in the middle of the trading range, but if we could pop that trading range, we just put in a divergent low. We had a divergent low there. We took out this downtrend line right here. And so here's what I see on this one. Again, this is if the market holds up for a while. If it doesn't, then these guys are going lower. And guess what? See that big trading range? Guess what happens? We go that way, right? So it's easy. These are easy trades. You can do one of a couple things. You could take it now if you want. We're in no man's land. No man's land is what I call when you're smack between resistance and support, and that's where we are right now. Here's the current price, right in the middle. Most objective is you can buy it at the bottom of the range, and then you put a stop below. But if you take it here, you'd still have to have a stop below to the bottom of the range, or what I say and or. So let's say you buy at the bottom of the range, or now. Your next buy point or add-on to a full position is a breakout above the range. It's a big old gap they'll want to fill right away, and then another gap, and then this thing could head on up there. Again, it's a nice chart. It's positive divergence. The stock has been beat down and left for dead. And look, this is long-term support too. So let's just for a second try to imagine that the U.S. and China come and reach some pretty favorable, reasonable terms on trade agreements, and all of a sudden there aren't big tariffs on Chinese goods. Maybe then Dollar Tree has the edge on Dollar General, right? Because no matter what happens, we know with an absolute certainty there's not a person in America that's going to work for anything remotely close to the wages that someone in China is working for. Their cost of production is a whole lot lower. That's why just about everything you buy comes from China. So we're light years away from where we're going to work for this. In other words, if we get something goes back to normal, then Dollar Tree all of a sudden might have the advantage. Right now, it's add-in or advantage for Dollar General because of the tariff talk. So that's why I'd be more of a seller right now, as I just was today for DG, and I'm not a buyer yet for DLTR, but I'll watch it. And will I short it if it breaks below there? I don't know, maybe. I believe we're in a bear market with a lot more to come. Remember, I'm showing you levels that in a bull market, I'd be an aggressive buyer. I believe we're in on the early stages of a much longer bear market. This is, let me box it. This is the weekly chart I just toggled to. There's our secular bull market uptrend line. So this tells me what I already know. Most stocks have been, didn't just start, but have been in a bear market for over a year now, a year or more. This stock peaked with a divergent high. That's negative divergence. This is my chart. I haven't touched this since back then. That was back in 2023. I noticed that divergent high. There's a downtrend line. And this is a stock that broke its primary bull market uptrend line there. And what happened? It fell to solid support. Now, if the market's going to go to new highs, this thing's probably going to break up and run up there. Otherwise, we break down and we can go quite a bit lower. And then I go to the monthly charts, and I look and see just how far this thing could fall. All right, guys, I'm going to wrap it up here. I will continue to post frequent updates. Watch the market leaders. Remember, news events could be positive or negative. The market's still in a precarious technical posture. We're in a downtrend. We're in a near-term and intermediate-term downtrend. There's no signs of reversal yet. All we have are key stocks falling to or just below support. We also have the indexes falling to pretty good support, as I pointed out. And so, like I said, we're pretty stretched. And I'd be surprised if Washington and some of the other big countries like China aren't talking. They, again, it's a zero-sum game. So I'm sure they're going to figure something out sooner or later, lest they risk the entire financial system breaking. Because as I said, you watch things like financials, then the banks, the non-bank financials. There's XLF, doesn't like it. Big banks are starting to drop. JP Morgan, falling hard. This is remember what I told you yesterday. Up until yesterday, the banks were holding up. Remember I had covered JP Morgan at Sport? The banks are now breaking down. This needs to get resolved. I don't know Trump's mindset. I know he's, has a chip on his shoulder, a vendetta against the Democratic machine that tried to, lock him up in prison for life and throw away the key. So I don't know if he's, his mission is to crash the system here for some reason. But if it's not, then they're going to have to come in and do something soon, because if you see now the banks are falling, that increases the risk substantially. Before tech was fine. Tech was bloated, extremely overvalued, overhyped with AI. So tech could come down and still be in good shape on the longer term charts. But like I told you, if the banks start showing cracks, people are going to worry whether they're legitimate selling, legitimate selling or not. Carry, I told you the regional banks done. This is just after that back test, they keep falling. Watch some of the big names, sort it by. I showed you this the other day. Go sort by the gainer and losers, and you look at things like this one falling today, the Bancorp 12% drop, 13% drop. Like I said, they're going to have to come in and do something soon, or we could see things get from bad to worse in the markets. Oof. All right, I'm going to get this one out to you. Continue to hunt for trade ideas. You have a bunch out there. I've thrown crude oil, natural gas, which usually go up inversely, but the levels are there. The levels are the levels. Copper, told you that one hit my price target pretty quick, 10% plus there. What else? All right, I'll stop here. This has been Randy Finney with Right Side of the Chart. Have a great day.